Okay, so we'll start to make a bit more of a move now. We've had a few more people join us. Now, where shall we start? Well, basically, when it comes to online trading, trading is something that I know a lot of people hear about. You probably see it in the news, you see it on social media, etc. But unless somebody's actually taken the time to explain what trading is, you know, it may just seem a bit foreign and a bit, you know, here or there. Well, the whole idea of today's session is to be able to put some clarity in terms of online trading, what it actually is, the risks involved, you know, how they can benefit you, any opportunities moving forward as well, which will be able to help you. But this is just the start. Okay, so this is just pretty much a very basic introduction to online trading. I understand there's people that are at different levels here, so some are more advanced than others, which is okay. But the main thing is just to be able to give you a good idea. So as I said, if there's any questions you guys have throughout this webinar, pop your answers into the question and answers box there, and we will detail them. Alternatively, you know, you are able to communicate with me via the chat box as well. So we've still got some more people coming in. So probably going to hold off for maybe one more minute and see if anybody else joins before, you know, starting the presentation. But for those of you who don't know who I am, my name is Durrell Innis. I've been in the trading industry for maybe about 4 years, and I started trading for the first time when I was in university, which was about 10 years ago now. And I was just messing around with trading Forex, etc. And then, you know, throughout time, I just kept practicing, kept learning, until I ended up having a big break. And then, you know, I've decided that, you know, I want to be a professional trader. So without boring you too much, I'm not going to get into the details of how I started out, because we're only going to be here for an hour, but ultimately, I am a good teacher and I am a good mentor to be able to demonstrate to you that if you do apply yourself in trading, and you do take the right actions and the right education, then you can go on and become successful, you know, in an industry like this. Now, what I'm going to do is I'm going to go ahead and start the webinar now, because we've had a few more people join, and I can appreciate that, you know, other people may be on a time limit. So as I said, yeah, my name is Durrell Innis, and we'll be going through the fundamentals of online trading today. Okay, so what we'll be doing is I'll be talking a little bit about the company that I work for. So I work for the CFI Group. We are a global group, but I work for the UK entity. You can also see what else we'll be discussing today, which is what is online trading, trading decisions, what are CFDs, how the CFDs work, trading with risk, and also the questions and answers at the end. So as I said, if you do have any questions throughout this webinar, pop your questions into the question and answer box, which you should be able to find on your Zoom link somewhere, and then we can, you know, go through them at the end. All right. So CFI, what we do, we're an online broker. Okay, we're a global online broker, and one of our core missions is to be able to deliver with passion the innovative and competitive trading way. All right. So as you already know, this is online trading. So online trading can be very remote now. It can be done from your laptop, from your computer, from your mobile, iPad. It's very flexible. And what we, you know, endeavor ourselves on here at CFI is to be able to ensure that we can put you in touch with the markets at any given time, okay? Because as you know, these financial markets, you know, they're 24 hours, 5 days a week. So it's really important to make sure that you're trading with a company that can put you in access in the markets, all right? And that's something that here at CFI, we you know, pretty much, you know, pride ourselves on. What we do as a group, we offer over 13,000 trading products. So I'm not going to get into all of them, but that covers Forex, indices, etc., stock shares. We have over 160 employees as well. Okay, so that's worldwide. We have over 21 international markets that we offer our trading products to. We have 15 offices worldwide as well. So we're here in London. We also have offices in Dubai, in Lebanon, in Cyprus, Mauritius. There's there's a lot more. We have 8 global licenses. So these are our regulation licenses. So here in the UK, we're regulated by the FCA, which is the Financial Conduct Authority. We have 3 trading platforms which you are able to trade upon, okay? And our headquarters, as I mentioned before, is one of our offices, which is situated in Dubai. As touched on before, these are our regulations. So it's really important to ensure that when you are investing in regards to a company that are regulated. Because if not, then you may not know whether or not your broker is acting in your best favor, okay? So here, as I said, we're here in the UK, so this is our FCA number. But as I said, we've got offices and, entities all over the world in Cyprus, Dubai, Lebanon, Jordan, and Mauritius as well. Here as well, we also have our sponsorships too. So it's really important to ensure that we get the right type of credibility and the branding across for our group. We recently had Pep Guardiola, who is a Barcelona legend, it's for those that follow football, and he's also the Man City manager at the moment. Pretty certain he's going to go on to win the Premier League again, as long as they don't slip up. And that was announced literally, I believe, at the end of last month. So that was big news for us to be able to welcome him on board. And no doubt it's going to, spur on to bigger and better things in the future. And for anybody that follows Formula E, which is the electronic version of Formula One, we also sponsor the Nissan EDAMS team. So each time, the Formula E comes to London, we will be there, and you can see us here as well as part of their sponsorship. CFI UK, so what makes us different? Okay, so we are an award-winning broker. We've been running for over 24 years, and we have that experience in the financial markets. We are also fully regulated here in the FCA, which is also by the FCA here in the UK, which is very important. We offer over 8,500 tradable products, and we also give you 24/5 client support, so you can get in contact with us anytime. And we also have helped thousands and thousands of customers to be able to get in and out of the markets and make them, some reasonable money as well, okay? The markets which we specialize in are mainly Forex, oil, metals, so that's gold, silver, platinum, palladium, etc. Futures, in terms of future contracts, stocks and commodities. And these are all offered in terms of our CFD tradable assets, which you are able to go on and trade. So commodities are things like coffee, wheat. You can actually trade pretty much anything that you can find, more or less these days, but that would fall into our commodities section. Okay, so that's most of the kind of, how can I say, for more, not boring stuff, but just the stuff that we do have to cover. Now it's time to get into the more exciting stuff in terms of what is online trading. Okay, so let's do it. So online trading refers to buying and selling financial securities over the internet, usually through an online broker like us, CFI, and an electronic trading platform like MetaTrader 4 or 5. Okay, it's all done very, very simple. Now, because technology is caught up, a long time ago, if you wanted to trade the financial markets, you would have had to have had a broker that you'd have to call up, every day to be able to tell him the orders. He'd have to tell you the price. You then have to decide whether or not you want to take that price or you'd want to wait, etc. It was very, very slow, and the commissions were a lot higher. So people didn't trade as often. Now, due to the internet, it's very simple, it's very flexible. You can trade short-term, long-term, medium-term, however you want, okay? That's based more on the trading strategy, which we'll get into. But online trading is basically buying and selling financial assets over the internet. trading decisions. So as you understand, for markets are there, the markets are always running. Can be very, very, very confusing for us to know how to make trading decisions. You know, do we want to buy gold now? Do we want to sell it? Do we want to wait? Do we want to sell euros now? Do we want to sell our pound? Who knows? It can become very, very, very confusing. So what we do to help us make our trading decisions is we look at market analysis. Okay, so market analysis is how investors and traders make buying and selling decisions based on studying and analyzing previous data and history and present elements. So the whole point of market analysis, it allows us as investors to understand the market sentiment before investing. So for instance, anybody that's following, let's say, the S&P 500, the FTSE 100, even any types of stocks and shares, because they're literally all taking a battering at the moment, we can see that the overall trend of the market is down. Therefore, why would we buy the market when it's down? Okay, we're better off going along with the trend and selling the market because we can clearly see that the trend is down. Okay, so that's one of the key things. You know, we need to use market analysis to be able to give us our sentiment when it comes down to making our investing decisions. By using market analysis, investors and traders can reach buying and selling decisions faster. And there are two types of market analysis which we use as professional traders. One of them is fundamental analysis, and the second is technical analysis, and I'll be going into both of those now. Fundamental analysis. So what is fundamental analysis? Fundamental analysis is a method of finding an asset's intrinsic value, okay? So what that basically means is we want to find the real value of an asset. We want to find the value's real, we want to find the asset's real value, okay? And there's variable ways we can do that, but we tend to focus more on the real value, okay? So for instance, if it's like, how can we say? So if it's like gold, for instance, gold can be very volatile. Oil can be very volatile, but what we often find is that the market will always react to news. So for instance, when we had the war broke out in Ukraine, that sent the price of gold and oil crazy, okay? And the prices were flying. However, you would also find that once the hype is kind of worn off, then the prices tend to come back to their normal average real value, okay? And that's what we would look for in terms of fundamental analysis. So fundamental analysis uses financial statements, industry trends, and market releases to see if an asset is under or overvalued. So what we look for in terms of fundamental analysis, we'll be looking at central bank interest rates, we'll be looking at the inflation as well. We'll also be looking at GDP reports, etc. We'll be looking at job reports as well to find out unemployment. We'll also be looking at geopolitical tensions as well. So as I said, what happened in Ukraine is going to give us, you know, going to make the market extremely volatile. And when that does happen, it allows us opportunities to be able to go on and, you know, make some money, okay? We track interest rates all the time as well. So the central bank interest rates. So if they go up, that means it's going to have a big impact in terms of the overall interest rates across the country. And we also want to keep an eye on inflation as well, okay? So inflation, as we can see, is it's very high at the moment. So because inflation is high, that will put a big impact in terms of what's happening in the markets, which is the reason why you can see stocks falling very rapidly, because inflation is rising, and the only way to be able to control inflation is to be able to up the interest rates. And technical analysis. So we understand that fundamental analysis is looking more at the stats and facts and the figures, okay? So that we're looking for the real intrinsic value there. What technical analysis does is it's kind of the opposite. Okay, so technical analysis attempts to identify opportunities by looking at statistical trends such as movements in market price, volume, and patterns. Now, I personally follow technical analysis. I am a technical analyst, and I do take into fundamentals. I mean, I do follow fundamentals. I do think it's the core of your trading decisions. However, technical analysis is also extremely important, because before I ever make a trade, I always look at the charts, 100%. I will not trade blind. I won't just trade on a whim, or because a war's broke out, or because this has happened, because it doesn't work like that. You're gonna lose money. You have to be able to look technically at something and be able to come to a clear conclusion of whether or not this is a good opportunity that you want to be able to take, okay? Now, one of the ways to be able to do this is to be able to identify patterns and trends that suggest what the market will do. So for instance, you may be able to look at the bar charts. We call that price action, okay? So it's being able to read what the candlesticks are showing us on a chart, okay? And then we also want to look at the trend, because the overall trend direction is going to help us stay on the right side of the trend. So in trading, we often say the trend is our friend. We want to trade the trend. We want to trade in the direction with the least resistance, okay? So if we can see that the market's going up, we don't just want to buy into the market at any given time either. What we want to do is we want to be very, very patient. We want to wait for an opportunity, maybe a pullback in that trend, to be able to jump back onto that trend, buy it at a cheaper price, and then be able to continue riding the trend in the right direction, okay? Popular signals for technical analysis are moving averages, which I definitely use, okay? Which is just giving you an average movement in price over a period of time. Support and resistance levels, which are another key technical indicator which I use. So I'm looking for breaks. I'm looking to see if price is holding or if price is rejecting certain key levels. Trend lines, again, which I mentioned again, you want to make sure that you're trading in the direction of the trend. So using trend lines, to be able to cap the highs and the lows of the trend will definitely help you out. And you'll be maybe looking for breakouts or looking for rejections at those trend lines to make sure that you're on the right side of the market. And we look at momentum indicators too. Okay, so those indicators may be like the RSI, for stochastics indicator. There's a few others. The MACD, for instance, can also be other popular technical pieces of analysis. But what you want to do is you don't just want to take one, or just take like a moving average, or just take a trend line. You kind of want to merge them all together, and then from there we begin to get a bit of confluence. But that's something that I'll discuss at a later date. Thanks for everybody that's joining as well. We're still getting more people coming on board, so I can see your messages there. So if you can hear me, thanks for joining us. You haven't missed too much, and if you do come late and you have joined us late, it's perfectly fine. This is a recorded session, so it will be recorded, and if you email me at the end of the session, I'll be more than happy to make sure that you get a replay of today's session. Okay. Now, what are CFDs? CFD is basically a contract for difference. So it is a legal binding contract here in the UK, which means that it's a commitment. It's your commitment to decide to either buy or sell a particular asset. So a CFD is an agreement between the price of an asset when the contract is open and when it is closed. CFDs are derivative products, therefore their price is dependent on the underlying asset to which they are linked to. You can either buy or sell CFDs. Okay, now this is really important, right? Because most people, when it comes to investing and buying stocks, let's say for instance, I wanted to buy a stock in, let's just say Barclays Bank. Okay, so I was looking at the Barclays Bank price, and I can see that it's going down. Okay, but the problem is that I've already bought Barclays shares about 2 years ago, and the price that I got it at, I was already in profit. However, let's say if I don't want to sell my entire share altogether, I still want to keep the physical share, but I can see that the trend is going down. I can see that the Barclays trend stock price is going down along with the rest of the market. I have two options. I can either I can either sell my stock altogether, okay, or I can sell it with a CFD contract, okay, meaning that I can then hedge my position because I'm already in a buy position. I can then hedge it, sell it, and then still be able to profit when the price comes down. Now, this is only possible with CFDs. This isn't possible when you own a physical stock. If you own a physical stock, you have to, you know, bear the ups and downs of the volatility of that certain stock price. When you trade CFDs, you don't. You can decide wherever, you know, when you can see the market's going up, you buy with the market. Simple as. But when you see it starting to pull back, correct, or even reverse, it also allows you the opportunity to be able to sell that position as well. That is one of the key advantages for contract for differences for CFDs. It also means that you are able to buy a full position of a stock asset or absolutely any tradable asset which we offer at a fraction of the price. Okay. Now, of course, there's an element of risk which I'll come into and explain later on, but they are the key advantages, and these are by professional traders and institutes like CFDs because they offer you that type of flexibility to be able to buy or sell a stock regardless of whatever's happening in the market, okay? And that definitely works in our advantage. Thank you as well to the, we got more people joining us too, so thanks for joining us. And as I said before, this will be a pre-recorded session, so don't worry about missing anything. I'll be able to send you a replay. Now, in terms of trading, what we do is we look at contract sizes. So I won't spend too long on this. Contract sizes is just basically our lot size. That depends on how much money we want to be able to place on that contract. It's as simple as that. So let's say, for instance, we were looking at selling 1 ounce of gold. Okay, this would be reflective in our trading account when we place a trade, and it would just say 0.10 or 0.1, etc., etc. So this is just basically the contract size. Of course, the bigger the contract, you know, the more money you can make. Okay, the smaller the contract, the less risk. Okay, that's pretty simple. Now, for financial markets, they are 24-hour. Okay, 24-hour, 5 days a week. So as you can see here, GMT time is 10 p.m. here in London time. So the markets will always start from that point. Okay, so last night was Sunday, so the markets did open. Okay, they did open. They open at 9 o'clock, 10 o'clock on Sunday for Sydney time. They will trade up until 10 p.m. this evening, and then at 11, that will constitute as a new trading day. Now, of course, because Sydney are in Australia, they start their trading day before us. Then it moves into the Asian session, which is the Tokyo session between 11 and 7 a.m. in the morning. And then we have the European session, which tends to start at about 6 and will run throughout the day here in London. So as you can see, we're based here. London session tends to finish at about 4 p.m. And then we have the start of the New York session. And as you can see, there's a bit of an overlap here. Okay, and between this session here at 8 p.m. and it's about 12, maybe 1 o'clock, maybe going to 3 o'clock, this is where we have the most volatility between this area here. So between 12 and 3, we'll have the highest trading volume. It's called the London and New York overlap. This is when volatility is the highest. You're always going to see most of the big moves happen around this time. This is when news releases will be announced. So NFP, this is when a lot of the new US data comes out as well, which also increases volatility. So, you know, the main sessions we want to be trading here in the UK are these 2 sessions. You can trade these sessions as well. They tend to be slower. And of course, you know, if you like your sleep, then you know, you probably won't want to, you know, trade these sessions either. But, you know, London and New York sessions anytime between 7 and 8 p.m., you're going to find decent moves in the market. So that's another benefit for us being based in London, is that we can trade any session. Okay, other cities and places around the world, they just don't have that flexibility. So there's been certain days when I first started trading, I'd trade all of these sessions. I'll trade the Tokyo session, the London session, and the New York session. And yeah, so you do have that degree of flexibility. So what I'm saying is, you trade the hours that suit you. However, between 12 and 3 is when we have the overlap, which tends to give us the most amount of volatility and movement in the market. And trading timeframes. So I often get, asked, people are like, Durrell, I don't have much time to trade. I work in like a 9 to 5, or I have a family, I have kids, or I have other things going on. I just can't find the time to trade. What do you advise? What do I advise? I think that you can do entirely whatever fits around your schedule. There's no right or wrong way to take money out of a financial market, okay, at all. I know some friends that love scalping. They only want to trade the 1 to 5 minute charts because they want to get in and out, put some big money on, etc. All right. Or I know people that just prefer to be swing traders, for instance. So we'd be looking at the 4-hour frames and the 9 and the 1 day. There is no right or wrong way to be able to trade. The main thing is that you find a trading style that suits your personality and suits your life. So if you know that you haven't got much time in the day, then it may, suit you to be a scalper or more of an intraday trader if you can only find a few hours in the day to trade. So if you are trading on a 5-minute chart, for instance, you know that within about 40 to an hour, 40 minutes to an hour, you could be in and out your trade. Okay, simple as. If you feel as though you can maybe commit about 8 to 10 hours a day trading, then you may want to decide to trade, the 1 hour time frame, because that's going to be a lot better for you. If you think, you haven't really got much time to be able to trade and you've got a lot of things going on, then we wanted to be looking at maybe being a swing trader. So that's when you trade the higher time frames, which is a 4-hour and a daily. And if you think that you haven't even got enough time to do that, and you just rather just be a position trader, then you'd be probably trading the weekly timeframes or the monthly timeframes and holding those trades for up to 8 to 10 weeks. Now, this is pretty much more for professional and seasoned and big money traders, but most of us will probably fall into, I wouldn't advise scalping either until you really know what you're doing. So I'd probably say you want to be trading in more or less the intraday and intraday swings. You're holding your trades for anywhere between 40 to up to a week or so, all right, which is fairly realistic and understandable. How to trade FX. Now, I'm sure most of you guys have been on holiday, okay, and you've had to go to a currency exchange bureau, and when you've got there, you've given them your pounds and they've given you an exchange rate and given you back an alternative currency. Forex trading is no different to go into that exchange or go into that bureau and deciding to exchange X amount of money for X amount of money. Okay, how we just do it electronically, and we have more information to be able to base those decisions on. So how it works, there's always a base currency and there's always a counter currency. So let's say, for instance, I had $100 of USD and I decided that I wanted to have euros instead. What I would then do is I would have to have an exchange rate. Okay, so I'd sell my USD for the base currency of the euros, and I would end up getting euros in return. Vice versa, if I had 100 euros and I wanted to exchange that into US dollars, they'd give me an exchange rate for how much it cost me to, well, not how much it cost me, or how much money I'd get for my euros equivalent in USD, which is the local currency. I'd just like to mention as well, while we're on the topic, Euro and the USD, they are the most volatile and the most, not the most volatile, the most traded currency pairs out of every Forex pair in the world. So very, very liquid. How to trade and what is a pip? So quite simply, A pip is points in percentage. That's what it stands for. Pip stands for points in percentage. It's the smallest increment in price fluctuations in currency prices. So what we have here is we have 1 pip, okay, which is basically 1 point. Some people say that pip should be 10 points in one, but you know, pretty much we keep it basic. A pip is this point here. If this goes to 10, then we may say, yep, it's gone up 10 pips, okay? That means that we've made 10% on this minor price here with this 1800 price. So it's always done in 1/100th of 1%, okay? So that would mean that we've gained 1 pip because this has gone up, this is 800, this has gone up 1 pip, all right? It's simple as that. Pips also fall back into contracts. So before, when I was explaining to you about for contract for difference, they all have to be put in terms of contract sizes. Therefore, when we had a look at gold, if it was just 1 ounce of gold, which would have been on a micro lot, that would give us 10 cents a pip. Okay, so each time that gold goes up 1 pip, then we'd get 10 cents. If we put a mini contract on it, we'd get $1. And then if we decided to put a full contract on that, then we'd be getting $10 per pip for every time gold moves in or against our position. And that's how it works. Different assets have different ways of formulating their pips. So as you can see, currencies is pretty standard across the board. Gold's pretty standard as well across the board. Oil's pretty standard as well across the board. But how they would calculate a pip in silver is 5 times the value in terms of what they would charge in terms of gold. So it's really important that we understand the contract sizes, because you may not want to put $50 a pip on there. You may decide to want to put something a little bit smaller. We've got a little bit of a typo here as well. That should be $5 as opposed to 50, just for the record. So how do CFDs work? Okay, so quite simply, CFDs, they allow you to leverage a position with a small percentage of capital paid upfront. So what that basically means is that you can sell a contract a lot bigger, okay, a lot larger than your original money could buy. So let's just say, for instance, an ounce of gold at the moment around $1,900. What CFDs allow me to be able to do is, if I think that gold's going to go up in the long term, I can decide, hey, I'd like to buy that ounce of gold, put my position in for 1 standard contract, but I won't have to pay the full value. Okay, I can get away with of buying that full ounce of gold with a smaller proportion. Okay, so I can maybe get into that position with 25–30% of the overall. Okay, that's the perfect thing about CFDs. So in this example here, we've got a trade on at the moment, which is the pound USD. So as you can see, for contract volume on this is 1 standard lot. Okay, so as we said before, if we're going back to our standard lots, we'll be looking at currencies, which is going to be here. So we can see that that will be formulating £1 per pip. Okay, so £1 per point. The entry is at 124965, which is here. Okay, as you can see this line, they've decided that they believe that the market will move up. So they've entered a buy position. Okay, not too sure why, but they must believe that price is above these moving averages now, and the price is going to push back up. They put their take profit in here for 125465, which is exactly 500 points away from their entry position, so 500 pips. And their stop loss is also 500 pips away from their entry position. That gives us a risk-reward ratio of 1:1 and a profit or loss of 500. Because bearing in mind, remember, it's £10 a point, or it's £1 a point, 10 points per pip if you want to, put it like that. So then what we do is we times 500 by 1. Okay, that would give us that take profit here, which would be plus 500. Okay, so how this would work is, if price pushes up to this point here, before we TP, if price is up here and then we TP, it means we make £500. If price pushes down to this point here, okay, then it means that we would lose £500 because it means that we'd be stopped out. All right, so this is basically a simple way to explain how CFDs work. Once a trade is on, all you have to do is be patient, set your risk to reward, make sure that you're trading in your right direction, and then you just wait for price to either TP or hit stop loss. Within that, there would always be a spread. Now, a spread is what we use as brokers to be able to show and demonstrate that we can get you in and out of the market. Now, as you can see, there's always going to be a spread here. So the spread will be 18. So if we go back to the points here, that would be just 18 pips. Okay, so that would be 18 of those small points here. So instead of it being 18.01, what the broker will do is it will quote you 18.19. Okay, that would be the cost of you getting into that trade. All right, so as we can see here, that there's an 18 pip spread. Pound USD, there's going to be a spread. This is for oil spread. So each currency, each asset will always have their own spread. Okay, that would fluctuate depending on the broker, depending on the times, etc. Some as well is commission based. So some brokers will charge you for getting in and out of a position. They won't really charge you much of a spread, but they'll just charge you, just for coming in and out of the trade, which is fair enough. We also have swap rates as well. Okay, so depending on if you're holding a trade and it has a positive interest rate, then you'll be able to have that opportunity to be able to pick up that swap rate. Vice versa, if you find that the interest rate is a negative, then you'd be charged the swap rate. The rollover rate is basically a rollover rate because each time you hold on to a position overnight, you are charged and expected to be able to as I said, so these rates are always applied at the end of the trading day, which is 10 p.m. London time. And we also have for rates that are rewarded for, of course, the markets are closed on the weekends. So what most brokers will do is they'll tend to bunch together those weekend rollover dates and just pay them on Wednesday. So it's not like you lose out, but of course the markets aren't open on Wednesdays, aren't open on the weekend. So you tend to get that money on the Wednesday. Okay, so that's basically CFDs trading and how they work. Now we're going to go into the risks that are associated with trading. There are risks involved because these are leveraged products. We are trading, with leverage, so we need to ensure that we understand the pitfalls. Trading is also very speculative. Okay, so you are going to be making speculations within the market based on your own analysis and your own trading decisions. So one of the key things to remember when trading CFDs is that we are using leverage. Anytime you use leverage, you're basically borrowing money for something that you don't initially have. Okay. Now, because the forex market is so big, it's so liquid, there's over $5 trillion moving through it in per day, you're not going to be able to buy into a position normally without the leverage. All right, it's just not going to happen. So what leverage is just trading mechanism that investors can use to be able to increase their exposure to the market, allowing them to pay less than the full investment amount. Okay, like I already mentioned, we use leverage to our favor. We don't want to use leverage against it. So that's why it's really important that we make sure that we're making smart trading decisions, because if you start using leverage and you're making poor decisions in trading, you're going to lose money. Okay, and we don't want to do that. Vice versa with margin. It's also important to understand your margin as a trader. Your margin is how much money you put into the account. And let's say for instance, you put £5,000 into an account, trading account. That £5,000 can only stretch across so many trades. And that's what we call our margin. So if we end up putting trade upon trade upon trade upon trade, what will end up happening is we'll be called full margin. We'd be in full margin mode. Now, when full margin happens, you leave yourself very vulnerable to the market, because if there's a sudden movement in the market either way, then you're going to end up, maybe having a margin call. Okay, and a margin call is basically a call from you, what used to be a call from your broker that would tell you, say, listen, you know, your positions are running against you. You need to put in more money, for instance, or something like that. Or, you know, they may just start, you know, closing out your positions automatically if you don't, you know, manage your margin yourself. So it's really important to understand that you appreciate the power of leverage, because it can be very useful to making money, but it's also important to understand that, you know, you're controlling your margin as well. So you're not getting taken out just because of, you know, standard market volatility and movement. What is volatility? So as we already said, volatility is a measure of how fast prices move over a period of time, and for a particular financial product. So what you'll find is some markets will be more volatile than others. So for instance, the oil market and the gold markets are very, very volatile compared to maybe a Forex market, like let's say the Aussie dollar, New Zealand, for instance, where it's not very volatile, doesn't move much. So volatility can be good for trading, but it can also be bad for trading as well. Okay, so you have to decide whether or not you think that you're a volatile trader. Me personally, I don't mind volatility. I'm a bit more experienced, so I know how to handle it. But I do remember when I first started trading, you know, some volatile pairs like the pound yen, for instance, was very volatile for me. Euro USD can be very volatile as well because it has, you know, one of the highest trading volumes, etc. Trading gold was also very volatile as well. But those volatile markets can also make you a lot of money. So you've got to understand how to be able to use volatility to your advantage, because once you understand that, then you know, it might be able to help you make money, but also save you from losing, you know, money as well. Trading psychology. Now, trading psychology for me is probably one of the key things that any trader has to kind of develop and work on themselves. Okay, trading psychology is basically our emotions in terms of what happens when we come to making investment decisions. Okay, now at this point, I'm probably just gonna, if you guys can see in the chat box, emotions. What type of emotions do you personally think can pop up when you're trading? Doesn't make a difference if it's right or wrong. I'm not going to, you know, put anyone's answers out there, but what type of emotions do you think could probably creep into, you know, your trading? And yeah, we'll go through them. Okay, brilliant. So we've had brilliant. So Makai, you've said greed, which is true. Okay, greed. Greed we often don't see as an emotion, but it's probably one of the biggest emotions. And thank you, Harvey, as well. You've gone in with the other side as well. You said both. You said fear and greed, which is right. Fear and greed and fear. These are two of our key emotions when it comes to trading. So when the markets are moving up, what state do you think that the market's in? Would you say when the market's moving up, would we say we're more greedful or fearful? The market's going up, right? So we're going to be greedy. When we see price going up and it's going in our favor, we begin to become more greedful. We begin to think, wow, this is great. I'm making money. You know, this is perfect. You know, I feel great. You know, I can't believe I'm reading the markets and I'm getting this right. So it's very easy to become overconfident, to become overzealous, to be able to start thinking, you know, all these, you know, beautiful, euphoric feelings of, you know, yeah, I'm making money and this is great, you know, perfect. But then when the markets are going down and we're seeing red bars, that's when we see fear creeping into the market. Okay. Now, people don't like to lose money at all. I've never met one person that enjoys losing money at all. So what often happens is this is reflected in trading. So we often see markets move up a lot slower than they fall. Because when people are making money, they're more inclined to stay in the trend. maybe even add to the trend. Say, hey, this is great. I'm making easy money right now. I'm going to put in some more contract size. I'm going to put in some more trades. I'm going to put in more this, more that. But then when the markets are going down, they're like, oh no, I can't believe this. I'm losing money. I don't want to lose any more money. Let me pull my money out. And then somebody else does it, and then it has a chain reaction. And in trading, we often say prices will always fall faster than they rise. And that's for that exact reason. And thank you as well to somebody else that put in FOMO as another trading psychology. FOMO is very, very important. Very, very important. And it's something that I struggled with a lot when I first started trading. FOMO, for the users that don't know, is the fear of missing out. So how many times, you know, for instance, have you seen a market and think, oh, wow, for instance, let's use Bitcoin, for instance, you know, Bitcoin went up to 60,000 and people started to, you know, think, oh no, you know, I want to join this, you know, I want to join the bull run. So I'm going to buy Bitcoin at its highs. They were FOMOing into the market. They were making an emotional decision into the market because they felt like they were missing out. Okay. When gold was rallying up to almost $2,000 an ounce, people thought that gold was going to continue pushing up. So they probably bought at 2,000 an ounce and they didn't wait for the market to reset. They didn't wait for the market to calm down. It's really important to remember that we are in a speculative market. Okay, it's emotions that drive any market. Doesn't make a difference what market it is. It could be the Forex market, gold market, it could be the housing market, it could be your local fish market. They all work in the same way. All a market does is put together buyers and sellers. After that, it comes down to your own psychology. How confident you are, how greedy you are, how fearful you are, how much anxiety you have, how competent you are. These are all going to have a massive impact. So for me, I always say it's very important to ensure that when you do start trading, you're aware of your own psychology, you're aware of your own emotions, because if you aren't in control of your own emotions, then you're going to find it very difficult to be able to, you know, trade in a very, you know, professional manner if you're just getting controlled and swayed around by, you know, all your emotions all the time. One of the other risks as well to trading is knowledge and skill set. And it's more to the point of a lack of knowledge and skill set. Okay, so they're the main reasons why new traders tend to fail in the markets. It's got nothing to do with the markets themselves. You often hear people say, oh yeah, you know, trading's risky, or investing's risky, or this is this, or, you know, I can't seem to make money in the markets, etc. The reason why they can't make money in the markets is because they just haven't taken the time to understand. As bad as it sounds, and, you know, I know there may be people on this webinar right now that may have struggled with trading in the past. You may still be struggling, etc. And I don't want to sound rude, but, you know, there are reasons why you are failing, because take it from me, I know successful traders and I know traders that aren't successful. And the experienced traders trade a lot differently to the inexperienced ones. All right. So if you do want to improve your trading performance, you do want to become a better trader, a better investor, you need to take time to be able to educate yourself. You need to take time to be able to invest into your own skill set too, because ultimately, when you become more confident in your trading, it's going to feed into your trading psychology. You're going to become more patient. You're not going to FOMO into the market. Okay, you're going to have a strategy, you're going to have a system, you're going to have some rules. I hope that, you know, you're going to have a rules-based approach to the markets. So it doesn't mean that you're just waking up every morning, you feel, oh, I feel like trading today, and I feel like putting a standard lot on and trying to make, you know, 500 pips on gold or pound USD. No, you're not going to do that. You're going to have a very, very structured plan. Okay, so and that's what we call our trading plan. So we want to have a trading plan. We want to know our objectives when we're trading. Okay, you may decide, oh, to have like maybe like a profit target for the day, and say, look, once I've made £100 or £200 for the day, you know, that's it. I'm not going to take no more trades. That's what we call discipline. All right. When I first started trading, I didn't have a trading plan. I didn't have any discipline. I just used to trade until my heart was content. And if I had a good day, then, and I made some money, I'd be happy. If I lost some money, then, you know, I'd be a bit annoyed, but I'd be optimistic I'd make it back the next day. But that was when I first begun. Now the way how I trade now to when I first started trading is completely different. Okay, so having a trading plan and having an idea of what your expectations should be from trading are going to be extremely important. Also, a lack of risk management as well. So in trading, we want to make sure that we're always managing our risk. Actually, that should be our first priority as trading, because this is our money. All right, we don't want to be taking wild speculations with our money. We want to ensuring that we're putting the right risk management in place. That could be done by making sure that you maximum risk 1 to 2% per trade. Meaning, if you've got an account with £1,000 in, you don't want to be taking a loss larger or risking more than £10 of your account on any given trade. Now, there are reasons why we do this, but the obvious reason is we don't want you to blow the account. We don't want you to lose all your money, okay? Because trading is very speculative. So we ensure that we put together the right type of risk management parameters to ensure that you survive for another day. We want to treat trading like a business. You know, if you had a business, you wouldn't just make decisions based on one day or on 1 week or on 1 month, would you? You know, you wouldn't say, oh, I'm going to go and buy all this stock, or I'm going to go and do this, and I'm going to do, because your business isn't going to last. You know, if you go bankrupt because you haven't managed your business properly, that means that you're either going to have to put more money into the business, or you're going to have no business altogether. So we need to keep that same mentality when it comes to our trading. We need to make sure that we're always managing our risk, making sure we've got a trading plan, making sure we're not over trading, and we've got realistic expectations of the market. Now, look, you're always going to hear these freak stories of somebody that's been able to turn £1,000 into £100,000 in 3 months. Yes, it does happen. It does happen. Okay, I'm not going to say it doesn't. There's been a few crazy type of gains that I've had myself, okay? But I'll be the first person to tell you that I wasn't sticking to risk management. I'll be the first person to tell you that I was also over trading, you know, and I'll also tell you to be the first person to say that although my expectations were realized, I was also unrealistic in those expectations, because I was trying to, you know, go for bigger rewards and bigger profits. And for me to be able to do that, I was taking, you know, bigger risks. And it's something that, you know, you shouldn't do until you are experienced. So until you get to a point, until you know what you're doing, it's very important to make sure that you stick to your trading plan, you manage your risk, you don't overtrade, and you have realistic expectations of the market. If you have all of those put in place, you should set yourself up for success. So how do we manage risk at CFI? So as we've already spoken about leverage here, okay? You can have leverage up to 400 to 1, but that's reserved for professional clients only. But for retail clients, it's 1 to 30. So what that basically means is for every £1 you have in your account, the broker matches it by 30, okay? So if you have £1,000, you'd be really trading with a trading capital of about £30,000. If you have £10,000, you'll be trading with a trading capital of £300,000. Okay, that allows you to be able to get into the market at 30 to 1 leverage and still be able to leverage your money to be going to get exponential gains. Here at CFI, we also do daily analysis and webinars from our team of market experts. So this is just an introductory webinar right now. We do have plenty other webinars too, which you are able to join on and learn and, you know, educate yourself, which I would advise, you know, to anybody wanting to learn more about the markets. We're also available 5 days a week as well, 24 hours a day. So you're more than happy to get in contact with myself or any of the other members of the team if you do have any questions around trading or you know, investing. We offer stop loss and limit orders on all of our market instruments. So, and this example I showed you before, you're kind of already defining your risk. You know, if you're going to go 1 for 1, if you want to put your stop, your take profit targets in and your stop loss targets in, perfectly fine. And we also have free demo accounts for you to be able to practice on as well. All right. So anytime you feel as though you're not ready to risk real money, or you don't feel as though you've got your trading plan together, that's perfectly fine. Okay, head over to one of our demo accounts, practice the strategy on there. If you have any questions again around setting that up, then you can always get back in contact with us too. So we're coming to the end of the webinar. It was only going to be for an hour, so I've tried to kind of just run through it. But we are at the questions and answers part. So are there any questions in regards to anything that I've kind of covered today? Absolutely anything, or any questions in terms of anything that I haven't covered. So, you may have questions around trading, around investing, around what we do. I'd be more than happy to be able to answer them for you. So if you do, the question and answers box is open. And if you don't, then that's perfectly fine as well. So I'll give you a few minutes to be able to think of some questions, and then and yeah. We also have a Telegram group as well, which you're able to access. Within a Telegram group, we give daily analysis. Okay, so we give daily analysis of markets and our expectations of them. You can also be able to have engagement with some of our other members of the group as well. So we've got a few questions coming in. Some of you have put them in the chat box, which is okay, and some of you have put them in the questions and answers box. So I'm going to start with one of the questions. It says, do you have a Signal group? Also, would you recommend any books? Okay. So the longest story short is we don't pretty much have a Signal group as such, but we do give you kind of analysis in the market. All right. So as a broker here, we are FCA regulated, so we're not permitted to give financial advice. Okay, so if we told you to take a trade and you lost that trade, and you complain to the FCA, that would mean that we are in trouble. All right. But what you can do, Cass, is you can give me an email, and I'll leave the details at the end. You can give me an email, and I will be able to get back to you about, how you are able to go around getting some type of signals, or just having a little bit more support with your trading. In regards to, do I recommend any books? Yeah, I do. I recommend you read Trading in the Zone. Trading in the Zone, I'm not sure who, I think it was by Mark Douglas. I could be wrong off the top of my head, but Trading in the Zone, it's also an audio book on YouTube too. So that's worth listening to if you can't be bothered to read it, because it is quite a long book. But I listened to that audio book plenty of times. It's about 2 hours. So if you aren't doing anything, you're going on a long drive, definitely Trading in the Zone is good. And there's another one, but unfortunately I forgot the name of it. But Cass, if you give me an email at the end, I will definitely get back to you in regards to your questions and any of the other good books that I can recommend. Makai, you said, do I invest on behalf of other people? I have and I will, but that's not really the sole purpose of today's webinar. It's just more of an introduction into trading and how it works. But again, by all means, Makai, please do feel free to message me at the end of the seminar. I'll leave my details there, and then by all means we can always catch up privately. And Harvey, you've mentioned, do we have any lectures or structure in terms of it? Right, so again, Harvey, that's something I think I've spoken to you about as well. Message me privately, Harvey, and then I can always give you more details in terms of how you can structure a trading plan. Now, the whole idea of this webinar was to kind of just give a bit of an introduction into the world of online trading and how it can work. I understand this isn't going to be, an opportunity for you to be able to understand everything about trading. All right, it was never meant to be like that. It was just more or less an introduction to set your appetite and to be able to give you, an idea of what to expect in the future. Here I've put up the socials there, so you can find us on Facebook, you can find us on Instagram, LinkedIn, WhatsApp, YouTube, and also we've got Twitter. We have got a Telegram group as well, which I've got the link to, but again, I'll have to send that to you privately because it's not here. But overall, what I wanted to say is trading is very, 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 it's a great opportunity, and it can be life-changing if you allow it to be. With me, it took me a while. There is going to be a learning curve. It's not going to be like an overnight success. It's not going to be quick money. It's not going to be a get-rich-quick scheme. And I know that there are plenty of people on the internet that are marketing it like, look at my flash car, look at my flash watch, look at my designer clothes, etc. We try to take a different approach here when it comes to trading. We try to take a professional approach. So, I don't want anybody on this webinar thinking that this is a get-rich-quick scheme or this is an easy way to be able to make money. What this is a profound way to be able to make money. Of course, it is leverage, and you do need to be, aware that there are those risks involved. But as we mentioned already, you need to have a trading plan, you need to have a trading strategy, you need to have a trading system, and you need to allow time in the market. And what that means is by learning to be patient, learning to compound. Okay, so that's one of the key things, and one of my key strategies to my success is I allow my profits to compound. Okay, so I don't just take the profit out and spend it on whatever. No, I leave it in there and I trade again, and then I trade again. So those of you that understand compound interest and the power of compound interest, there's also another great book on that as well that you may want to log into and read. Compound interest is how we make a lot of money when it comes to trading. Okay, so we're not just trading for volume, we're not just trading for money. We're trying to use our trading account as such to become our savings account, and then from when it's our savings account, we can grow it into becoming our pension account or whatever account you need in the future. That's the whole idea of it. I hope you guys have enjoyed today. Are there any other questions that anybody may have, or you may want to know why you've got me on the webinar? Okay, so look, a few people are asking, how to be able to reach me. So what I'm going to do is I'm going to go to the very top of the webinar where my details are there. So what I think the best thing to do is just to email me. So my email details will be at the top. Just bear with us. So if you can just email me here. This is my email address, d.innis. Type that down, and what I would suggest is any questions you have, just email them to me. Okay, so I know there's a lot of you guys that are asking, pretty much, if I can give you guys additional support or additional this. Best thing to do is email me, and I can always come back to you on a case-by-case, status, because I know that some of you are at different levels here. But what I would like to do is I'd like to thank everybody for attending. I really would. Okay, I would like to thank you for attending. This was my first webinar with CFI UK. Was a bit nervous to begin with, but ultimately it's been good and I have enjoyed it. Thank you guys for your participation. This will be happening on a more frequent basis, but as I said, what I plan to do is, this was just the fundamentals of online trading. I plan to scale it up and make it a little bit more interesting for you guys, okay, as time goes on. Sorry. And yeah, if there aren't any more questions, if there's anything, if there's nothing else I can do, then I'll be more than happy to thank you guys for coming and attending, and yeah, we can leave it there for today. All right.